Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me at _finance, and if you want to join our community, finding-value.com, where I dive deeper into all these sectors, looking for investment opportunities. It's mainly in commodities. That's where I think the value is. Emerging markets, international equities, and commodities. But for the most part, I really like commodities because that's where I think the big asymmetric opportunities are at. I have midweek updates. We do Q&A sessions on the weekend, and if that's something you're interested in joining, we've got special as the coupon code. You can try it out. You get $25 off the first month, which ends up being $25 for that first month only. And it's a $100 discount on the yearly membership. Ends up being $500, and you can swap whenever you'd like from a monthly to a yearly if that's what you want to do. So, investment wisdom: the fact that people will be full of greed, fear, or folly is predictable. The sequence is not predictable. So what he's saying is you cannot time that market. So what they do, Warren Buffett and also Charlie Munger, that's why I say they, what they do is they prepare for fear. The fear in the market is what gives them the opportunity or the disconnect between price and value. So they sit there, they say, you know what, I can't predict this. We can't predict when people will become fearful. It could be at the drop of a 9/11. It could be a C-19 event. It could be something that sparks it. Who knows? And who knows exactly when? Generally, those events do occur when the yield curve is uninverting. So a lot of people do try to make those predictions. They try to say, well, you know, when the yield curve uninverts the 2 and the 10, we get these recessions. And we've had the 2 and the 10 coming down for a couple of years now, which makes me think that, yeah, you can't really predict when, but you can prepare for it. Preparing means that you hold a bunch of cash. You wait for fear to get into the market, and when the fear comes, you load up. You load up like you've never loaded up before on assets when everyone is fearful. But you have to be level-headed, logical. You have to know that it's coming at some point. You don't know when, but at some point it could come. And you just sit, you wait, you're patient. It occurs, and then you pull the trigger. You pull the trigger when everyone else is unable to pull the trigger, either from fear or either from they don't have the money. So that's kind of what their approach is. And they're just stating that these emotions will be in the market, and we're going to wait until fear gets in the market, and then we're going to start pulling triggers in terms of buys in particular assets. Seth Klarman says the single greatest edge an investor can have is a long-term orientation. Well, why is that the case? Why is a long-term orientation the greatest edge? Because everyone else is short-term. So what you need to do is you need to take advantage of short-term market orientation and exploit it using long-term orientation. And that also connects with this first one. So when everyone is fearful in the market, they're all scared, they're selling their stocks at bottoms. If you have a long-term orientation, you're not selling, you're buying. You're taking advantage of short-term, we'll call it short-term emotional investors. And since you're long-term oriented, you can wait it out after buying assets that are very cheap. This is your greatest advantage, is to exploit short-term market thinking, short-term market timers, the technical analysis people only that try to do this in the short term. Now, I use technical analysis, but I don't use it in the same way that a lot of other people use it. So they use it as a determining factor of buying or selling something. So they'll say, this is where resistance, this is where support's at, this is where I want to put a stop loss. I don't do that. What I do is I use it for the big picture, big long-term view. You back way out, and then I use technical analysis to see where the big bottoms are. I accumulate in the big bottom area, the accumulation zone or phase, and then ride it all the way up. And I use it to determine where the value is, if things are starting to break out or change from a downtrend to a base to an uptrend. And then I buy that whole bottom. And then I use it for the big picture, lining up the big move, and then holding through. The problem that I think a lot of people have is that they get scared in the short term. So they try to use it for short-term little market movements. Timing the short term is impossible because anything can move a stock price in the short term. You could have random news come out and people get scared and they go from greedy to fearful in a heartbeat. And then all of a sudden everything's selling off. They use price as the indicator. So as price goes up, they get greedier. As price goes down, they get more scared. And if you don't know anything about the underlying asset that you own, then it's easy to get fearful. So when you look at all this and you're trying to invest, you got a bunch of people who know absolutely nothing that are just a bunch of emotional investors going in and out of stocks all the time. That's all it is. But if you take a big picture view, you can say, okay, I'll buy a whole bunch here when no one's looking at it. It's really cheap. And then you just sit and do nothing. And then you may have to sit and do nothing for 10 years. And people can't do that. They don't want to do that. Most people I think have the gambler mindset. They want that adrenaline. They want that pump. They want the short-term little pump in their body. So investing is you just sit and you don't do anything, and it's not as like this excitement roller coaster. Catoosa research, the market still prices copper like it's just another cyclical metal. When a market misreads a structural change, prices usually adjust. For copper, that means prices are likely to rise. And I would agree, copper projected to climb 30% over the next decade. And I just look out there and I'm like, how are we going to solve this? We have big deficits coming in copper. Prices will go up and demand will have to get destroyed. I mean, that's just what it is. And then we'll have to look at for substitutes and all sorts of stuff way out in the future. But yeah. Have you ever held through a 50% drop in price? Yes, no sweat. Yes, barely. No, never had to. Show me the answers. I am part of the yes, no sweat. I've held through many 50% drawdowns. What I try to do, I try not to get the 50% drawdown early on, which means that I'm doing an okay job on my entry points. If you buy something and it goes down 50% right off the bat, that stings for me. And it stings more than a 50% drawdown that I get later on. I want to try to be as successful as I can on my entry points, which means I'm buying real cheap. They're very low. They're not super volatile. They're kind of in that dead period where things are all squeezed up. Usually that's a pretty successful endeavor to do that. Pretty good entry points. There are times where I do mistime something and I have to ride down 50, 60%, even though the stock is down 90% to begin with. That has happened. What did I do? And what was my approach? My approach was to buy more. I bought a whole bunch more. Why did I do that? Because I understood the company. So in those types of scenarios, yeah, it's no sweat, no big deal. I know the company, I know what I'm buying, I know it's underpriced. I might have mistimed it, and I go in and I buy more. There are companies where maybe you buy something and you misread something with the fundamentals of the company. and maybe they have too much debt and you didn't realize how much debt they had. And you're like, you know what? I don't want to take this risk. And maybe you have to reevaluate the decision of buying it in the first place. And that does happen every once in a while. But most of the time, I would say I don't have to live through a 50% drawdown. You're going to get volatility in the short term, 10, 20%, but that's just normal. The trading type, people who are traders, this is what their answer is. And I just laugh at it. I think it's a horrible solution. They'll say, oh, well, I'll put a stop loss. I'll put a stop 10% below my purchase price. I'll put a stop loss. You do realize that most commodity companies can move, 10, 20% in a day, a lot of them. So what happens there is if you can't time the bottom within 10%, you're going to get stopped out every single one with a 10% loss. That is a horrible strategy. Absolutely horrible, in my opinion. Most of the time, I don't. I would say this: I never use stop losses. Never. I go in, I buy it. I could have volatility, and some people say, "Well, you're down 20%." It's like, yeah, but if I hold on, which a lot of the companies I hold on, they end up being multi-100% up. So in the beginning, I can't time within 10% of a bottom. Hardly anybody can. Hardly anyone can get within 10% of the absolute bottom. And if you're buying and you're never getting and experiencing any of these bottoming type moves, that means you're just buying on the right-hand side and you're only buying into strength. And you're probably not buying close to the bottom. You're waiting for momentum to get generated first, which means that you're off 40, 50, 100%, 200% up off the bottom. And that would be at the same exact price that I purchased. And then I cost averaged in the whole bottom, which ended up being a better strategy than those that are only buying into strength. So what I found is the strategy that's the best, that nets you the lowest price, is that you got to kind of stick your neck out there and try buying the bottom. And if you've got a 60, 70% success rate doing it, you're going to have to manage the other 30, 40% that you have to deal with it coming back down. And usually cost averaging in can fix that. It can mitigate it. They may not fix it, but mitigate it. So what if silver does get past $50 here and finally holds? What happens when the curse of the 45 years is finally lifted? What happens when the exuberance of new uncharted highs becomes a reality? Could you see a relatively quick doubling? Anything's possible. It doesn't matter, guys. Everyone talks about, well, what if we break out of the, guys, interest rates are going up and that's when silver goes up, period. So we're going to break out of this pattern. We're going to go way higher. And wherever it ends up, it ends up. The question is, where should you be buying silver? When was the best time to purchase it? In my opinion, it was 14, 15 bucks in 2018, all the way up to, say, 2023, 2024. Now, as we start to break out of everything, the momentum guys are all going to get on this. The technical analysis guys, the guys that buy breakouts, they're all going to come next. And then they're going to be like, well, what if it goes up a lot? What if we break this? It's going to do it. I mean, are you telling me that it's not going to do it? I mean, what are the chances that silver doesn't go up? And tell me the reasons why it won't go up. It's because we have this gigantic surplus. In the beginning, we're going to get resistance. And the resistance is from retail, the weak hands selling all their silver. Then after that, when they figure out that we don't have enough physical silver to do all this AI and all the stuff that we want to do in this world, then it's going to keep going up. That's my guess. That's what I think is going to happen. But trying to predict the short-term market movements is dang near impossible. And all I see on Twitter are people trying to predict short-term price movements or talking about it. Lots of talking. It's like, okay, we've got the pattern. We've been talking about this pattern for a while. And it's a big pattern. And it's going to take a long time to play out. Totally agree with that. I've been in this since 2018 and even before that. I was in it. I bought some back here, back in here, and then I bought a whole bunch in 2018. That's when I loaded the boat, was 18. But the longer time frame you have and your ability to look at price movements with, how can I say it, like it doesn't impact you, the better off you are, the more resilient you are. And then you just look at everybody, and everybody's running around trying to make these price predictions or using technical analysis. They're telling you, oh, it's going to do this and it's going to do that. And then people think that these guys know what they're talking about. All I'm going to say is chase value. Chasing value will keep you safe no matter what the technicals necessarily look like. And then you have to adopt a long-term outlook. And then you beat everybody because what you're doing is you're exploiting the weaknesses of them. Their weakness is a short-term market orientation, and their weakness is trying to predict prices. So how do you take advantage of that? You buy it when it's cheap, which keeps you at the bottom of the cycle, and then you just sit and wait, and you take a longer-term outlook. And that's exactly what I've done with everything. You buy it when something's real cheap, and then you just hold on. And then people will say, well, you were down this year. It's like, it doesn't matter. Tell me what you're making. Oh, I made 10% this year. Well, I made 50 in that single year. I made 150% some of the years. I don't see a lot of people doing that. What are your total returns? Garbage? Well, great. Mine are great. The key is the strategy that's the best. And the long-term strategies beat the short-term strategies, period. Coming out of Lucas, he says, we've entered the age of money printing. Roughly 80% of all U.S. dollars in existence were created in the last 6 years. That's why inflation remains sticky. The printing press is still running in overdrive. Before 2021, we had over 40 years of disinflation. That's true, declining interest rate environment. In other words, nearly every analyst and investor built their career in a disinflationary environment. Completely agree. Even now, after 4 years of elevated inflation, most still dismiss it as temporary. Even though the Fed itself went from inflation is transitory to we're not focused on inflation. At some point, people will realize that inflation is here to stay and capital will rotate from growth to hard assets. Yeah, I totally agree with that. It just takes time. You have to subject the herd to this market condition for a long period of time, and then all of a sudden they give up. They say, okay, this is here. Monetary base continues to rip it, and inflationary times are coming. How will more rate cuts fix this? It says the middle class is buckling under years of inflation. Workers are growing tired of an economy in which everything seems to get more expensive. Change in personal finance situation over the last year, middle income. And a lot of people think that they are worse off than they are, say, 5, 6, 7, 8 years ago. So they're buckling under inflation. How will rate cuts fix this? I don't think anything's going to fix this. What fixes it is a sound monetary. It's a sound currency. That's why in the Constitution they put gold and silver as being money, not this BS currency crap. Here's another one. It says most of silver owners have under 50 ounces. Hit 200 ounces and you're in the top 10% worldwide, which is the estimations. So 200 ounces and you're in the top 10% worldwide. That's good. That's not that much, 200 ounces. I mean, there was a lot of times that I purchased far more than 200 ounces in single purchases. I'm definitely above the top 10%. A viewer shared this with me, and I think it perfectly tells the story of how we've been screwed over, saving gold and silver. So 1964, the minimum wage was 5 90% silver quarters. In 2025, 5 90% silver quarters have a melt value of $45.20. We don't need minimum wages. We need sound money. Completely agree. That's your problem. Your problem is sound money. That's the solution. Your problem right now is we don't have sound money. Another one from Seth. He says, you must buy on the way down. There's far more volume on the way down than on the way up, and far less competition among buyers. It is almost always better to be too early than too late. And that's exactly what I do. I buy when things are coming down and they're really slow. And then you just kind of load in when no one's looking. Now, I'm a smaller investor. If you have to deploy a lot of money, you have to buy into weakness because that's where your volume is created. That's big, big money. Um, in Jesse Livermore, The Reminiscences of a Stock Operator, he goes over about unloading shares of a company that the insiders wanted to unload. And there was volume that was created with a bunch of news around a stock that he used to offload all that volume into. So it makes sense. It makes sense that if you're a big buyer, you would like to buy when others are selling because that's the volume that gets created. Kobayashi letter says the U.S. wealth gap is widening. Americans aged 70 plus now own a record 38.9% of all U.S. equities held by households. The percentage has surged 10 percentage points since 2020 and has doubled since 2008. As a result, these individuals currently own 19.9 trillion of equities and mutual funds. At the same time, they own a record 32% of all U.S. household wealth, or 53.1 trillion. By comparison, this percentage was 20% between 2006 and 2010. The wealth gap across generations is widening at a record pace. I think that all goes back to sound money. I mean, some of this is kind of obvious to me. Like, I'll just say this. Um, if I were to compare myself today with myself 20 years ago, I am far more wealthy today than I was 20 years ago, and that's just myself. Now, if you were to compare most people, they are going to be the most wealthy when they're old, and they're going to be the least wealthy when they're very young, like 18, 19 years old. The wealth gap gets widened when you've got old people owning a bunch of assets at the end of their life, and then all of a sudden you raise all of the prices of the assets way up. And those who own very little assets, like those that are younger, including my younger self, versus my older self, like I am today, if you were to increase asset prices, I would be far more wealthy at an older age than I would be at a younger age. The name of the game when you have a depreciating currency is to load up on assets as quickly as possible. That's the name of the game. It protects you against currency debasement and it increases your wealth. So when I read these things where, they'll say like Americans age 70 plus now own a record 40, almost 40% of all US equities held by households. It's kind of like, well, if people are living longer, so see, this doesn't make, I don't like these statistics. Why? I mean, we've got a gigantic demographic. We have a gigantic number of people entering 70 plus, the baby boomers. And these people are living longer. So you have a larger population that is living longer entering this age group. And they now own 40% of all US equities, right? And they say down here, as a result, so at the same time, they own a record 32. So by comparison, this percentage was 20% between 2006 and 2010. The baby boomers weren't in that, that's a much smaller population, number one. And number two, they didn't live as long for a lot of them. So I don't know if this is a good comparison. You see, this is where you need to think. They have all this data, and it's like, oh, it's going up. Well, it's a combination of asset prices going up. It's a combination of a far larger population going into this age group, and they're living longer. And back then, the percentage of people over 70 plus was far less a percentage of the population. So I don't know what this means. This is useless information. You're comparing a smaller demographic to a larger demographic. It's like, duh, duh. Like, God, I saw this and I'm just shaking my head. You've got to be prepared when you buy a stock to have it go down 50% or more and be comfortable with it. Yeah, it's true. Master's degree in finance, JD, traded my own money for almost 14 years. I've used technical analysis, fundamental analysis, algo, swing trading, day trading. What have I learned? Build a business and set your portfolio to 80% gold and 20% silver and do nothing. That's how you win, says the ranch lawyer. Yeah, I'd agree. That's pretty much one of the large asset allocations that I have. As physical methods. The crisis hiding in your wallet. Why $58 oil means you're about to get much poorer. Let's see what this is about. It says, listen carefully. What I'm about to show you is simple math that Wall Street prays you never understand. The ratio that predicts everything. Okay, you got my interest for sure. Oil prices today, $58 a barrel. U.S. money supply today, 22.2 trillion. You divide those two, you get 0.00259. This exact ratio appeared 3 times in history. August of 1998, oil then jumped 186%. February of 2016, oil then jumped 158%. April of 2020, oil then jumped 157%. We hit 0.00259 again in September of 2025. The pattern has never failed, not once in 27 years. Why does it happen? When money supply explodes but oil prices stay flat, something breaks every single time. Since 2020, they printed 40% more dollars. Oil stayed at $60. This creates what physicists call thermodynamic impossibility. You cannot print energy. You cannot create barrels with monetary policy. See, this is what I say. And people call me crazy in the comment section. My comment was, printing money is oil demand. I'm going to read this again. This creates what physicists call thermodynamic impossibility. You cannot print energy. You cannot create barrels with monetary policy. Someone has to pay the bill. History says it's always you. The supply crisis is already locked in. U.S. oil reserve is 410 million barrels, the lowest since 1984. Days of coverage in real disruption, 9 OPEC real spare capacity, 3 million barrels per day global investment shortage. So the real spare capacity is 3 million barrels per day globally. The investment shortage is $180 billion per year for 10 years. The math is brutal. We stopped investing in 2020. Offshore oil projects take 5 to 7 years. The 2027 supply gap is already baked in. Nothing can fill it now. 2027. The detail that changes everything. AI data centers will need a power equal to 1.5 times the entire U.S. electricity grid by 2030. Grid connections take 7 years. AI deployment takes 18 months. That gap gets filled by burning oil and gas. Tech companies will pay $300 per barrel oil equivalent because losing the AI race means corporate death. This is the first time in history oil demand becomes strategically inelastic. Recession won't kill it. Price won't kill it. Nothing kills it. What happens next? Mid-2026, oil breaks $100 when inventory data shows the real shortage. Late 2026, it hits $150 as everyone realizes spare capacity is gone. 2027, your government announces fuel rationing. Not maybe, not if things go wrong. This is the base case now. The math nobody wants to see. Total U.S. financial claims, 100 trillion, fraction backed by energy. The assumptions are it's a 10% minimum. that $10 trillion in promises of global oil production, 25.6 billion barrels per year. To clear those claims, $390 per barrel oil is required, and the current price is $58. The gap between what is promised and what physics can deliver is the largest in human history. I hope this is making sense to you guys. They print a bunch of money. Oil is like the backing of the money supply, so to speak. I know that's not going to make sense to people. But whenever you do anything in the system, anything, it requires energy, and it's mainly driven by oil. So he's just doing the quick math. Here's 5 facts you can verify right now. Check Fred economic data. The M2 money supply is 22.2 trillion. Check EIA. Oil's 58 and the ratio is that. Check DOE, Department of Energy. Strategic reserves is 410 million barrels. Check the IEA, International Energy Agency. Global investment is 590 billion versus 770 billion needed. Check Baker Hughes. The U.S. rig count dropped from 625 to 554 in 3 years. Every number is public. Every number is verified. Every number points in the same direction. So what's going on here? Why is this time different? Previous oil shocks had 1 or 2 risk factors. This has 6 simultaneously. Money printed with zero constraint, AI creating price-insensitive demand, investment blocked by politics, alternatives cannot scale fast enough, geopolitics fragmenting supply chains, and all buffers depleted before crisis starts. This has never happened before in the 165-year history of the oil industry. So what do you do now? This is not investment advice, this is physics. The last time this ratio appeared, people who understood it made generational wealth. People who ignored it watched their purchasing power evaporate. The window closes when oil breaks $85 a barrel. After that, everyone sees it and asymmetry disappears. At 58, you're seeing the biggest setup in 30 years while the crowd still thinks everything is fine. The ratio is 0.00259. It has never lied. It's a flashing red. Read the full data here on that. And that's these really cheap areas that you can buy where this ratio is located in history. And it's never failed to turn back to its average and higher. Just wanted to go over that. It says, learn this early, master it, and the world is your oyster. It says, there are times when playing the stock market that your money should be inactive, waiting on the sidelines in cash, waiting to come into play. In the stock market, time is not money, time is time, and money is money. Often, money that is just sitting can later be moved into the right situation at the right time and make a vast fortune. Patience, patience, patience is the key to success, not speed. Time is a cunning speculator's best friend if he uses it right. Patience to get that fear in the market and buy it when things are cheap. That's where I'm going to end it, guys. That's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like, especially with the coupon code. If you want to play that oil market, I've got a heck of a good group of companies that we can play that oil move with. I'm already positioned. I've been positioned. There's still some that are down that have great entries. Maybe I'll buy some more in. But, man, it's coming. I think energy is just completely mispriced here. And with them printing money, that's coming. That's what gold's showing us. That big move in gold up is accounting for money being printed, and then it works its way through the system. All right, guys, that's all I've got. See you later.